If you are ready to start investing in the stock market but aren't sure of the first steps to take when investing in stocks, you've come to the right place. Would you be surprised to learn that a $10,000 investment in the S&P 500 index 50 years ago would be worth more than $1.2 million today? Stock investing, when done well, is among the most effective ways to build your wealth. And I'm here to tell you where to start from. There's quite a bit you should know before you dive in. Hey there, my name is Ken, and here's a step-by-step guide to investing money in the stock market to help ensure you're doing it the right way. Make your first trade the like button and invest in subscription to the channel, and let's go! You're also welcome to support the channel, all the links are down in the description. Let's take our first step. This will be determining your investing approach. So the first thing to consider is how to start investing in stocks. Some investors choose to buy individual stocks while others take a less active approach. Which one are you? The one who is an analytical person and enjoy crunching numbers and doing research, or do you hate math and don't want to do a ton of homework? The good news is that regardless of which of these statements you agree with, you're still a great candidate to become a stock market investor and do it successfully. The only thing that will change is the how. So I'm gonna tell you the different ways to invest in the stock market. There are three in general. First one is individual stocks. You can invest in individual stocks if and only if you have the time and desire to thoroughly research and evaluate stocks on an ongoing basis. If this is the case, I 100% encourage you to do so. It is entirely possible for a smart and patient investor to beat this market over time actually. On the other hand, if things like quarterly earnings reports and moderate mathematical calculations don't sound appealing to you, there's absolutely nothing wrong with taking a more passive approach. This is about index funds. In addition to buying individual stocks, you can choose to invest in index funds, which track stock indexes like the S&P 500. When it comes to actively and passively managed funds, people generally prefer the latter, although there are certainly exceptions. Index funds typically have significantly lower costs and are virtually guaranteed to match the long-term performance of their underlying indexes. Over time, the S&P 500 has produced total returns of about 10% annualized, and performance like this can build substantial wealth over time. Don't you agree with it? And third thing is robo-advisors. Finally, another option that has exploded in popularity in recent years is the robo-advisor. A robo-advisor is a brokerage that essentially invests your money on your behalf in a portfolio of index funds that is appropriate for your age, risk tolerance, and investing goals. Not only can a robo-advisor select your investments, but many will optimize your tax efficiency and make changes over time automatically. So also nothing wrong with choosing a robo-advisor. On the second step, you gotta decide how much you'll invest in stocks. Let's talk about the money you shouldn't invest in stocks first. The stock market is no place for money that you might need within the next few years at a minimum. While the stock market will almost certainly rise over the long run, there's simply too much uncertainty in stock prices in the short term. In fact, a drop of 20% in any given year isn't unusual. In 2020, during the COVID-19 pandemic, the market plunged by more than 40% and rebounded to an all-time high within a few months. So you never know what's gonna happen. So here are the examples of money that you don't want to invest. This might be your emergency fund, or money you'll need to make your child's next tuition payment, or the next year's vacation fund, or the money you are sucking away for a down payment even if you will not be prepared to buy a home for several years. So make sure to not use this money for investments because it can be uncertain in a shorter period. And if you've got money to invest, now let's talk about what to do with your investable money. That is, again, the money you won't likely need within the next few years. This is a concept known as asset allocation, and a few factors come into play here. Your age is a major consideration, and so are your particular risk tolerance and investment objectives. So let's start with your age. The general idea is that as you get older, stocks gradually become a less desirable place to keep your money. If you are young, you have decades ahead of you to ride out any ups and downs in the market. But this isn't the case if you are retired and relying on your investment income. Here's a quick rule of thumb that can help you establish a ballpark asset allocation. Take your age and subtract it from 110. This is the approximate percentage of your investable money that should be in stocks. This includes mutual funds and ETFs that are stock-based. The remainder should be in fixed income investments like bonds or high-yield CDs. You can then adjust this ratio up or down depending on your particular risk tolerance. For example, let's say that you are 40 years old. This rule suggests that 70% of your investable money, 110 minus 40, this investable money should be in stocks, with the other 30% in fixed income. If you are more of a risk taker or are planning to work past the typical retirement age, you may want to shift this ratio in favor of stocks. On the other hand, if you don't like big fluctuations in your portfolio, you might want to modify it in the other direction. All of the advice about investing in stocks for beginners doesn't do you much good if you don't have any way to actually buy stocks. To do this, you'll need a specialized type of account called a brokerage account. These accounts are offered by companies such as TD Ameritrade, E-Trade, Charles Schwab, Interactive Brokers, the link is down in the description, and many others. And opening a brokerage account is typically a quick and painless process that takes you only minutes. You can easily fund your brokerage account via EFT transfer, by mailing a check, or by wiring money. Opening a brokerage account is generally easy, but you should consider a few things before choosing a particular broker. First, determine the type of brokerage account you need. For most people who are just trying to learn stock market investing, this means choosing between a standard brokerage account and an individual retirement account, IRA. Both types of accounts will allow you to buy stocks, mutual funds, and ETFs. The main considerations here are why you are investing in stocks and how easily you want to be able to access your money. If you want easy access to your money, are just investing for a rainy day, or want to invest more than the annual IRA limit, you'll probably want a standard brokerage account. On the other hand, if your goal is to build up a retirement nest egg, an IRA is a great way to go. Of course, all these IRA things for US citizens. For non-US citizens, you just gotta go with individual account type. The majority of online stockbrokers have eliminated trading commissions, so most of them are on a level playing field as far as costs are concerned. However, there are several other big differences. For example, some brokers offer customers a variety of educational tools, access to investment research, and other features that are especially useful for newer investors. Others offers the ability to trade on foreign stock exchanges, and some have physical branch networks, which can be nice if you want a face-to-face investment guidance. There is also the user friendliness and functionality of the broker's trading platform. I've used quite a few of them and can tell you firsthand that some are far more clunky than others. Many of them will let you try a demo version before committing any money, and if that's the case, I highly recommend it. Of course, within this short video, I can't go over everything you should consider when selecting and analyzing stocks, but here are the important concepts to master before you get started. First one is diversifying your portfolio. Then consider investing only in businesses you understand. Avoid high volatility stocks until you get the hang of investing. Always avoid penny stocks because they are too risky. And the important thing is learn the basic metrics and concepts for evaluating stocks. It's a good idea to learn the concept of diversification, meaning that you should have a variety of different types of companies in your portfolio. However, I would caution against too much diversification because when there are too many stocks, it is hard to monitor them. Invest in businesses you understand. And if it turns out you are good at or comfortable with evaluating a particular type of stock, there is nothing wrong with one industry making up a relatively large segment of your portfolio. Buying flashy high-growth stocks may seem like a great way to build wealth, and it certainly can be, but I would caution you to hold off on these until you are a little more experienced. It's wiser to create a base to your portfolio with rock-solid established businesses. If you want to invest in individual stocks, you should familiarize yourself with some of the basic ways to evaluate them. My videos about investing in value stocks and dividend stocks is a great place to start. I'll leave the link up here. And if you want to add some exciting long-term growth prospects to your portfolio, videos about growth investing and small cap stocks is a great place to begin. Links are also here. And the fifth, the biggest secret of investing, courtesy of the Oracle of Omaha himself, Warren Buffett. You do not need to do extraordinary things to get extraordinary results. Warren Buffett is not only the most successful long-term investor of all time, but also one of the best sources of wisdom for your investment strategy. The most surefire way to make money in the stock market is to buy shares of great businesses at reasonable prices and hold on to them for as long as the businesses remain great, or until you need the money. If you do this, you will experience some volatility along the way, but over time you'll produce excellent investment returns. If you want to backtest all this, just look at Berkshire Hathaway's growth. I hope I was useful for you with the beginner's guide to the stock market. Let me know in the comments what is your first stock to buy. Here are more other videos about personal finance and investments. Make sure to subscribe to the channel, like the video and hit the notification bell. See you in the next video.